We must go to Wall Street because we are just 2 seconds away. There it is. The opening bell on a morning when Asian markets and stock futures have tumbled after presidential tweets about the China talks, or lack thereof, have investors very rattled. CNBC senior market correspondent, my dear friend Dominic Chu, has his eye on those very markets. And I'm joined right here in the newsroom by Dan Nathan. He's a CNBC contributor and the principal at Risk Reversal Advisors. Dan, futures down 500. Now the markets are opening. Here we go. Down 450 right out of the gate. How is this? Why are investors suddenly spooked now?
Well, I think it has to do with where we closed on Friday at an all-time high, if you think about that. So we've basically had, this Q4 2018 meltdown on a lot of the same issues that were down this morning. We've spent the last 4 months rallying back to make a new high. So we're really, at fantastic levels as it relates to the stock market, high levels of complacency. When you get a headline like this, we know that this is something that's caused volatility on risk assets the world over the last 18 months or so. So you have to kind of take it seriously. I don't think down 1.5% on the opening after a record high, after a 24% rally from the December lows, is all that bad.
But, Dom, why were we taking it seriously that the president or Steve Mnuchin were telling us the truth, that we were close to getting a deal with China to begin with?
Well, Stephanie, you bring up an interesting point, because it was about a week ago, it was probably exactly a week ago, that we heard from Treasury Secretary Steven Mnuchin, who was speaking at the Milken Institute Global Conference in Los Angeles, that they were, quote unquote, in the final laps of trade negotiations. That may be part of that setup that Dan was just referring to with regard to the markets. There was a sense in the marketplace building that we were kind of getting towards some overarching trade deal that would happen maybe as early as this month, the end of this month. But this particular kind of headline coming out, especially with President Trump saying it for the record on social media, on Twitter, is what made the markets get a little bit more skittish. This is very localized right now, Stephanie. There are specific parts of the market outside of obviously Chinese stocks, but it's technology companies and industrial companies in America that have the most exposure to business in Asia that are getting hit some of the hardest right now in early trading.
Dan, Axios is reporting that a source close to these U.S.-China trade talks says the president's view is he's negotiating from a clear position of economic strength, especially if you look at the amazing jobs number on Friday. Are any investors going to see it that way? Because China doesn't mind if they take pain. Xi Jinping, he's going to have that job for the rest of his life.
Well, I think that's a really important point. I mean, this essentially planned economy over there in China. We know that they have a 2025 plan, an economic plan. I think it's important not to think about this trade negotiation through the market lens, because our stock market is over $30 trillion in market cap. Theirs is about 6, 7 or something like that. So them being down 5%, it's just not that big a deal relative to their economy, relative to who owns stocks there, and relative to where that stock market has been. So you think about the economy, they have the wherewithal. I don't think that tweet storms are going to be the sort of thing that President Xi is going to actually kind of fall to his knees. I think it's also important to remember, while Mnuchin last week said we are at the final stages of a trade deal, we were also learning last week from some reporting that we were willing to give up on some of the most important aspects of the trade deal to get a deal done.
It's really important to remember China is responsible for a ton of wrongdoing. They do steal technology and IP. I mean, we do have to go after them.
Well, so it's really interesting when you think about Larry Kudlow, the Trump's main economic advisor. He's been against tariffs, for 30 years, railing against them for his entire career. And what he was most focused on, if this is a tactic to threaten tariffs, to get to right some of these ills about forced technology transfer and IP theft, then it's worth it in the near term with our economy and our markets doing the way they were. But last week we learned that they were going to maybe give up on that just to get a trade deal. And I think what's really important to remember is we don't have NAFTA 2.0 ratified.
And we need to remind our audience, last week Ivanka Trump at the Milken Institute on the stage was saying how fantastic USMCA is, how much better it was than NAFTA. Let's remind you, it's NAFTA 2.0. And it's not in place yet. We do not have it.
And Trump has been threatening auto tariffs with Europe. So we have these situations. Japan also. This China trade deal could be like a domino for all these other ones. And really what's happening is that we keep talking about the U.S. economy is doing well on a relative basis to Europe and to Asia. But what could happen is we have a very fragile global economy right now. And any fissures in this China trade deal will reverberate to all these other deals that are not yet done. And a slowing of economic growth would be the worst possible scenario. It would basically just smash all of the gains that we've had in global risk assets because of all this financial fiscal policy, really easy fiscal policy. We just had the big tax cut, and like monetary policy with interest rates that have been at zero for a decade.
Well, Dan, then I guess I will take this opportunity to remind you that President Trump said trade wars are easy to win.
Hey there, I'm Chris Hayes from MSNBC. Thanks for watching MSNBC on YouTube. If you want to keep up to date with the videos we're putting out, you can click subscribe just below me or click over on this list to see lots of other great videos.